Now, we're delighted to welcome at Quant Professor Andrea Ferrero. Professor Andrea Ferrero is Professor of Economics at the University of Oxford, and he served at the New York Fed for 7 years, as he was also senior economy. He's going to discuss long-run view of global imbalances, implication for growth, and geopolitical conflicts. Please, Professor.
Thank you very much. Thanks a lot for the invitation. Let me begin with a small premise. You're not my usual crowd. I tend to talk a lot to academics, a little bit to central bankers, and I say this with the utmost respect and intimidation. So I hope to tell you something interesting today and give you a bit of a perspective on recent events, starting from something that I've been thinking a lot about during the course of my career. So let me begin with something that you already know. Trump's economic policy, Trump's administration, Trump's campaign ran over two main pillars, tax cuts and deregulation, and tariffs. In April of 2005, the administration put tariffs on the table, and this was, big news last year. Were followed by several recalibrations during the year that introduced a lot of uncertainty. Recently, the Supreme Court struck off some of the tariffs, but in very Trumpian fashion, the next day, the president imposed global tariffs, first 10%, then 15%. Interestingly, shortly after the introduction of the first round of tariffs, the dollar depreciated by 15% against the euro. And this is actually the opposite of what you would expect, especially when it's the reserve's currency that introduces tariffs. I'm going to return to this point later on, trying to figure out why that was the case. So why tariffs? The way in which the administration relies on tariffs is really a historically anomaly. If you look at the evolution of tariffs, here's the case of the US. In one day, we went back to the average level of tariffs post-World War II. So it was a big change against historical trend that saw tariffs going down for a very, very long time. So the question is why? And the Trump administration sees tariffs as a way to address global imbalances. And hence, here is the connection with the title of the talk, how to think about these imbalances. So just so we're all on the same page, what do I mean by global imbalances? People have typically referred about global imbalances as large US current account deficits, that's blue line in this graph, vis-a-vis the large surpluses, especially in China. This was predominant before the financial crisis. There was a correction after that, but then another widening. The dashed line in this graph are IMF projections. Take them as you wish. But the fact is that we've been living in a world in which these two countries have represented the two sides of these global imbalances, and they're not the only ones. If you look at bilateral deficits for which we have data, China represents by itself about a third of the US trade deficit. And then if you add in emerging markets, you add in Asia, you add in Mexico, you get to about 2/3, and the remaining part is Europe and the rest. So the natural question is, why have we had these large imbalances for such a long time? And here is where, talks before were talking about failures of model. Here's one failures of economic models. Traditional explanations don't seem to really work well when you think about US versus China, US versus emerging markets. What do I mean by traditional explanations? Two of the most common explanations are about productivity, so countries that grow faster should attract capital and hence run a current account deficit. Demographics, countries that are older should be saving more. They kind of work if you think about the EU, Japan maybe, but they don't work for China and emerging markets. China and emerging markets are countries with high productivity growth, they are relatively young. Another common explanation is fiscal policy. So here's the idea would be that a country that runs fiscal deficit would be spending more than what it saves, and so would be running a current account deficit. Maybe works now or in the last few years, but the US administration were actually running surpluses when the US current accounts start widening a lot. So what are we left with? The most commonly accepted, perhaps, explanation that emerged in the last 20 years or so is what Bernanke called the global saving glut hypothesis. So what does it mean? In Bernanke's word, this represents a high demand for assets, safe assets in particular, or perceivably safe assets like US Treasury, denominated in the reserve currency, coming from China and other emerging markets. So far, this is kind of tautological, right? Because the current account surplus is an accumulation of assets, and particularly safe, but there's nothing too deep so far. What is Bernanke's story in his speech is the idea that emerging markets that in the late 90s experienced a wave of crisis, and potentially China worried about something like that happening to them as well, built a safety net. So accumulated assets in order to avoid a repeat of such a disaster. Possibly, that's maybe part of the story. But one thing that we know about these countries, and apologies, I don't know why the graph doesn't look great, but I'm going to try to talk you through it. One thing that we know about these countries is that for a while now, they have pursued aggressive industrial policy. So this is an industrial policy index that has in blue, so you kind of see, hopefully, the blue countries that are running current account surpluses. So the first one is Philippines, then you have, second one actually I can't read, you have Japan, you have China, you have Mexico there that is running a current account deficit, but remember that against the US as a surplus, and so on and so forth. So what is the point here? What are these industrial policies, first of all? There are a set of policies the countries introduce to subsidize certain sectors that they deem of strategic importance. And very often, this strategic importance for this country is related to the exporting nature of the sectors that are subsidized. This goes back to the famous idea that emerging markets grow through exports, right? So the idea is that this industrial policy subsidize and stimulate investment and growth and productivity in manufacturing, particularly in sectors that are oriented towards exports. This is actually not enough. You need a little bit more, because it could be that if you do that in isolation, a lot of the benefit would be absorbed domestically. The country grows faster, becomes richer. So you need a little bit more to explain why these countries are actually exporting a lot and running surpluses. And the idea is that in a lot of these countries, what you also see is what people call consumption suppression policies. So this is another kind of encompassing term that refers to the fact that these countries have adopted relatively tight fiscal policy, capital controls, reserve accumulation, often have weak social security nets. So these are all factors that induce their households and their firms to save, and that generates these surpluses, whilst at the same time maintaining competitiveness in terms of low wages and further stimulating investment. So again, graph has not come out beautifully, but what this is showing are some implications of this industrial policy. So on the horizontal axis in both charts, you have this industrial policy indices. This is actually a generalization that we've done in some recent work that use machine learning and natural language processing along the lines of one of the talks mentioned this morning. So we extracted mention of industrial policy from earning calls. So for the period 2002-2019. And on the vertical axis on the left, you have the change in manufacturing, employment, and on the right, you have TFP growth. And what this is telling you is that just as a raw correlation in the data between these two variables, what you see is that countries with more aggressive industrial policies are also countries that experience more growth in manufacturing and faster TFP growth. We've done some actually a little bit more sophisticated analysis in which we've controlled for a bunch of other factors, most notably these consumption suppression policies that I was telling you about before, and the correlation becomes even stronger. So there seems to be, at least qualitatively, some evidence that there is a correlation between these different variables. So just to go back to the initial point, what is the hypothesis here is that the combination of this industrial policy together with consumption suppression policy has led countries in emerging markets to run trade and current account surpluses. On the other side of this, there are countries that have not adopted these policies, and because trade must be balanced at the global level, those are countries that are running current account current account deficit. So in some sense, this hypothesis provides a different foundation for this idea of a global saving glut, not so much depending on countries preemptively accumulating safety as much as actively pursuing policies that stimulate their exports. And so this gives you a bit of a different perspective to tariffs. So going back to the initial point of the Trump administration imposing tariffs. If these surpluses that we see at the global level in emerging markets are driven really by fear of a crisis, then tariffs appear somewhat of an unnecessary imposition. But if the imbalances are instead driven by policies that these countries are pursuing actively, then maybe tariffs are necessary. So I'm not here to defend Trump. In fact, if you do write, a bit more of one of those models that may fail, but can sort of rationalize this phenomenon, tariffs remain a suboptimal tool. And the intuition is extremely simple. Basically, the reason is that you're trying to correct a distortion by introducing another distortion, which is a distortion on the price of imports. And similar result would be applied if you, as the US or other countries that are running surpluses, were to impose industrial policies on their own, because you would distort as well, in that case, the price of domestic manufacturing. What is ideal in this world is actually to try to stimulate domestic innovation. Because typically innovation requires some form of monopoly power to sort of incentivize companies to perform that type of innovation. And maybe socially, the level of innovation is suboptimal. You would actually like that innovation to be even stronger. So let me move on from this to talk about a little bit the implication for a current environment. So what we've seen as a consequence of this tariff and this tensions on the trade side is some sort of trade fragmentation. So on the left, what you see is sort of the adjustment of trade across different blocks. So what the chart does, just in a nutshell, is to show how both in the Western bloc and in the Eastern bloc, so here Western means US, EU, and aligned countries, Eastern means China, Russia, and aligned countries, and neutral means all the rest of the world. what you see is some reallocation of imports away from the opposite bloc towards within bloc. Okay, and this is true starting already in 2020, 2021, and then has continued over time. As a consequence, we've seen more trade fragmentation, which goes hand in hand with other indices of fragmentation. So here there are 4 of them: trade fragmentation, financial fragmentation, mobility fragmentation, that refers to mobility of factors, and political fragmentation, which is the one that perhaps is mostly in the news nowadays. So you see these indices of fragmentation going hand in hand pretty much everywhere. The other implication is related to what's happening with monetary policy. This is obviously a theme that is very dear to me because this is my other big research interest, and I spend time working in central bank. As I told you, I talk to central bankers fairly often, so this is something that I think about quite a lot. And what's interesting is that, again, talking about failures of models, what Econ 101, basic econ, will tell you is that higher tariffs means higher prices. But when tariffs were introduced, surveys asking businesses how much of the tariff increase are you going to pass on were giving very bimodal answers. Some firms would say, yes, we're going to pass on 100% of the tariffs. But a non-negligible fraction of firms said that we're not going to pass on anything, probably because those are firms that are more exposed to competition, both domestically and internationally, and so they're worried about the effect of increasing prices too suddenly on their customer base. When you look at inflation, you see that inflation following the introduction of tariffs has gone up. In blue, you have PPI, which is probably the most directly and immediately affected inflation index. In red, you see PCE, which is the index that the Fed targets. And you see this increase between April of 2025 and the end of the summer, like August and September. So this suggests that, it's obviously here I can't detect exactly which are the goods that has driven this increase in tariffs, but suggestive that perhaps the pass-through was actually relatively quick. And then sort of subsume, but then it's picked up again. And so new data will tell us a little bit more about what's going to happen in the future, which suggests that the overall monetary policy response, and hence where interest rates are going to go, is likely going to depend on new data releases. And this is going to interact with what's happening nowadays, what's been happening since last week with the war in the Middle East, which, if anything, is increasing inflation risk. At the same time, as it's going to also interact with the transition in the chairman of the Federal Reserve, with Kevin Warsh being appointed by President Trump, likely going along with the administration demands for lower rates. But at the same time, the additional inflationary pressures and the fact that the Fed was accused of being a little bit behind the curve in 2022 when we had energy price spikes may put the new chairman and the new Fed a little bit in a tight spot. So let me wrap up here. What I want to tell you is sort of a view of current events, so tariffs, related to global imbalances, a phenomenon that we've seen starting in the 90s. My hypothesis is that part of these imbalances may have something to do with policies pursued by emerging markets, this set of, or this combination of industrial policy and consumption suppression policies. In this world, tariffs remain a suboptimal tool, but at the same time, we can't always expect politicians and policymakers to do the optimal thing. You could do better with other policies, but it's unclear whether that's where we're going to go. Tariffs are clearly associated with an increase in fragmentation, with geopolitical tension. And this is something that can, cast doubts on what's going to happen in the future to the world order, including what I mentioned at the beginning. What's the reserve currency? It's going to be a realignment in the world order in terms of the role of the dollar, the emergence of new currencies, including digital currencies, etc. So this is the environment where we're living in, and I'm going to close it here. Thank you very much for your attention.
Thank you so much, Professor Ferrero. Professor Ferrero, also we're talking about something which is happening currently, and it's the top priority of not just policymakers, but of the market and the economy as well. Thanks again, Professor Ferrero. And before I switch back to Italian, torniamo all'italiano, perché prima di lasciarvi per il lunch break, due cose. Innanzitutto avete prima votato e alla fine il risultato definitivo della presentazione migliore del nostro Shark Tank vede premiato Fabio Massellani di Bitwise, a cui adesso consegneremo anche la targa. Eccolo qui. Si è fatto desiderare, ma poi quando è arrivato è stato efficace. Ma Fabio Massellani, allora questo è il nostro Shark Tank. E come vi dicevamo non è l'unico contest di oggi, perché poi c'è invece una sfida per quanto riguarda i social, quindi su LinkedIn, quello che sarà il post che riceverà il maggior numero di like, quindi di interazioni, vedrà alla fine del pomeriggio anche un bel premio per chi sarà ancora qui con noi dopo il lunch break, in cui inizieremo invece con una serie anche di tavole rotonde, di keynote speech, ad approfondire dei temi che andranno più direttamente legati anche ai digital asset, al Bitcoin e tutto quanto è l'evoluzione del sistema. Grazie a tutti, ci vediamo più tardi.